A lot of the gurus think it's all about mindset. If you think you can, then you will. And, too many people take that literally and just say, hey, I got a great mindset. I'm going to jump in. They cut corners and they're not good stewards of other people's capital. They're just not experienced enough.
Your network is your net worth. Come listen to some of the most successful people I know share invaluable knowledge, stories, and advice in real estate, business, and beyond. This is Weiss Advice. Whether you want to take your business or personal life to the next level, look no further. Welcome back to another episode of Weiss Advice. I am your host, as always, Yonah Weiss, and I am excited to be here today with a longtime friend and been wanting to get him on the show for quite a while. He may not read his DMs, which may be why we missed the opportunity in the past, but grateful to have Alix Kogan on the show, founder of Ashland Capital. Welcome. How are you doing, my friend?
Doing well, Yonah. How about yourself?
I'm doing great, all things considered. But very, very grateful to have you on the show. I know we've been in touch for years on end and, done a lot of work together. And, I've just been excited to see you in the growth that you've done. I know you've helped a lot of people that I know as well in terms of helping them get started in real estate. So it's a really, full circle in a lot of ways, and just grateful to have you on the show to kind of provide some education and Weiss advice, as I like to say, for our listeners.
It's a tall order, but I'll do my best.
Any advice is Weiss advice on this show. So it doesn't have to be wise or anything of the sort. But yeah, and I mentioned to you before the show, you've been in the business for a couple of decades. And I think a lot of people who are starting out, you've seen so many syndicators, right, come through the ranks and these different programs and coaching and all this kind of stuff. And it's like, I'd love to hear your perspective on someone who's been in the industry for so long and has seen so much. What's your perspective on what's happened over the past several years with so many newcomers coming to the show?
Well, it's certainly been interesting and eye-opening as the whole capital raising and syndication buzz grew over the last 7-8 years. I've always been a little bit leery of so many newcomers and such a low barrier to entry. And there's good and bad in that, of course. It provides people opportunity. If you have some ambition, again, the barrier to entry is pretty low. So I think that's good in many cases, right? It gives you that opportunity, and then it's up to you to, if you are sophisticated enough, hardworking, et cetera, and doing the right things. On the other hand, what I've seen is people just looking for a quick payday and taking lots of shortcuts, not willing to put in the work, the education, and just paying your dues. The mindset, and I'm going to use that word, which gets overused. A lot of the gurus think it's all about mindset. If you think you can, then you will. And, too many people take that literally and just say, hey, I got a great mindset. I'm going to jump in. They cut corners and they're not good stewards of other people's capital. They're just not experienced enough. They're not educated enough. And, of course, this market that we had with, free money and zero interest rates basically provided a perfect runway for the perfect storm. And here we are. So, I think I admire some people that got into the business, and I really shake my head at many who should have never gotten into the business, who should have gone and worked for someone else and paid their dues, frankly. I remember 20 years ago, maybe a little more now, 23, 4 years ago, buying my first piece of real estate. And I couldn't have been more nervous, thinking, what am I missing? What could go wrong? Sleepless nights over a very, very small piece of real estate. And I think more people should lose a few hours of sleep and really think about what they're doing and be more calculated. So I'll shut up there.
No, that's it. That's exactly what I wanted to hear. And it's providing that kind of insight from afar. And it does provide a lot of context also. It is easier. The barrier to entry is much easier, as you mentioned, but it also leads room for, as we, talked about earlier as well, before the recording, leaves room for bad actors, to come in and kind of take advantage of unsuspecting people. And unfortunately, we have seen that happen over the past year or two. And it's very unfortunate, but it kind of comes with the territory. And you have to be careful. You have to trust but verify in all situations. And even that can be difficult to do, especially when you have others kind of verifying on your behalf and not doing your own self due diligence. Kind of crazy world out there.
It is. That is.
Well, Alex, you mentioned that, buying your first property, a small piece of, real estate 20 some years ago. Can you kind of catch us up to speed how that progressed from, I know you started it kind of small and then you were in the construction aspect of it for a while doing ground up development. And then how have you transitioned to what your business is like today? I'd love to kind of hear your background, the story of how, Ashland was founded and then, to what you're working on today.
Sure. So it all really started way back, but we'll sort of just touch on that and then skip to about late 98, 99, when things really started and I started my business. But I grew up in a family of entrepreneurs. My dad was a builder, developer. My brother as well still is. So I say it this way, that I grew up around it. So I felt like the ability to jump in and do it was fairly easy because it just was around me. And it was something that I was comfortable with. And so, getting into real estate was somewhat easy for me. I guess maybe I was even overconfident that, if my family is doing it, I could do it. But I took a detour and did not want to get into real estate. Spent about 7, 8, 9 years roughly doing other things, doing a lot of travel in my 20s, traveling all over the world. Ultimately ended up teaching overseas, teaching high school here in the States. And I was against young and dumb trying to save the world and do different things, which I joke about that, but it was a great experience, but ultimately led me to the decision that it's not what I wanted to do for the rest of my career. And the entrepreneur in me, my roots of my family just finally came to the surface. And in 98, I moved out to Colorado, started my own company, which was a high-end design build firm. We built high-end single-family homes. Started out quickly. That business just took off. Right time, right place. And then I saw opportunities to start doing speculative work, whether that be entitling land, developing single-family lots, small subdivisions that led to some mixed-use projects, that led to townhomes, condos, led to a lot of single-family residential projects. So it was, two arms of the company where we were building super high-end, beautiful, one-of-a-kind homes for clients on their property, and then also doing development work on our own, doing our own projects. And then all that led to a good fortune, a good problem to have, that I was making a lot of money. Had a lot of disposable cash, and I was living well below my means. And I said, what do I do with all this money? So I started buying real estate. I'm building, but I wanted to put more of that money to work with existing assets that I can create cash flow. And like I'm sure you heard many people on your podcast, started buying single family, started buying duplexes, started buying in Colorado. There's a small college where we lived, and started buying college rentals, duplexes, triplexes, small multifamily, and renting to college students. Had a great experience doing that. Besides them trashing their apartments here or there, but they always paid. If they didn't pay, I had co-signers with parents, and so that was a great experience, as well as regular apartments that I bought and rented. So that really kind of took off on a journey of about 20 years of really building both sides of it, the development and building side, as well as the acquisition side of buying real estate. In about 2018, my wife and I decided that we wanted to move back to Chicago. We had our first child, our only child, 2015. And we decided to raise our son closer to family. My wife is from Detroit. I'm from Chicago. So left Colorado in 2018 and started to really unravel my portfolio of smaller assets. I built a good-sized portfolio of smaller assets. I ended up selling the construction and development company. And that's really about that time when I started using that capital after liquidating to buy larger assets, buy 100+ unit apartments, buy purpose-built student housing, which was an evolution from my college rental days. And that's really when Ashland Capital, as it is today, more or less, started to form and build and grow, and haven't looked back. Of course, we've had to pivot and adjust our business plan and how we look at investing over the last few years. But that's really been the trajectory to what we are today. And today we sit here with about $250 million of assets under management between our student housing and multifamily assets. And then in the last, I've always also been a private lender, that's one thing I failed to mention. Buying assets and also lending money over 20 years. Again, found myself with opportunities, whether it was lending to a fix and flipper, lending to a small business, whatever it was, that was always a part of my business. So all of that, and I continued doing that, for the last 20 years. When the interest rate environment hit, we haven't bought a single real estate asset for 2 years. The last asset we bought was at LSU 2 years ago. But as a result of that, our investors were saying, Alex, when's the next opportunity? What's going on? I mean, are you guys going to buy anything? Are you guys on the sidelines? What's happening? And I kept talking to my investors that, I'm just not comfortable with where pricing is. We're super conservative. We don't want to jump into the market when I just don't have good visibility. I don't have pricing discovery. There was just so many things going on. So ultimately, and my clients of many years, my investors knew that I was also a private lender, and we started talking about the debt side of the equation. So as a result, in response to our investors' need to place capital, we formed a private credit fund so that our investors could invest alongside myself on the debt side. So that's really where we've leaned into for the last couple of years, and have seen tremendous opportunities because of the obvious disruption in the banking industry, small businesses, fix and flippers, and even preferred equity sponsors who are buying student housing, buying apartments, have this need for pref equity. And specifically what we do is small checks, 500,000 to $1 million. Anyways, I'll try to wrap up the
there's a lot going on there.
Really leaned into that. We've got a fund that's going really well. We pay our investors a fixed rate and lend out money and do it over and over again. We will buy real estate. It's not if and when, and we're actually finally, knock on wood, getting close to an opportunity. We're negotiating a contract right now. Hopefully we get to the finish line. But yeah, we've sat out quite a bit in the last couple of years, and done with lending money out, but we will start to buy real estate, I guess.
For sure. Wow. Okay. So a lot to unpack there. A lot has happened. And, listen, condensing, 25 years into 3 minutes is not an easy task, and it's amazing to see, how that's progressed. The biggest question I have is, you talk about making the leap after selling your construction business to buy bigger deals. Like, what prompted you to do that and say, okay, I'm moving into, now I want to buy big commercial real estate projects? Because that is a big kind of, if you think about it, it's a big step. It's a big leap to do that.
It was actually a pretty easy decision to make. And the reason for that is all the real estate I owned was either in Colorado or a few things here in Chicago that I did with my brother. When we decided to move back to Chicago, I said to myself, how do I continue multiplying my capital? And I realized that I don't have to that real estate does not have to be in my backyard. So it was almost the only really option I had: buy larger assets where I could hire best-in-class property managers and oversee what they do from an asset management standpoint. It made a lot of sense to buy larger assets and sell off, of course, the smaller assets that really are smaller assets are just difficult to manage from a distance. So that was really how and why we did that.
Gotcha. Okay. That makes sense. Obviously, I think that's why most people go into buying commercial real estate, for that very reason. I was just kind of curious how you made that progression, but it makes perfect sense. Not everyone gets that. I mean, there are plenty of people out there who are still doing construction, still doing fix and flips and all kinds of things where they're not necessarily doing that, but that, I guess, that the perspective, the mindset, the knowing, the education really is more what anything else, knowing how that can affect your future.
Yeah, and I was comfortable with it because, we self-managed the smaller assets that we always owned, and it grew to be a larger portfolio and became a much bigger part of the business. So I was comfortable at the management side, and I knew that you have to be local to manage. So for me, again, buying a larger asset, not having to be a property manager, but hiring the best property managers and knowing the business, knowing how to manage them, and knowing where you can get in trouble, that was a pretty easy step. Now, don't get me wrong, I learn every single day, and it's not an easy business, but it was an easier transition for me because I have the background.
Absolutely. Now, having kind of looked back to when you started that to now, and like you said, past couple of years have been kind of on pause. You've been waiting it out, where a lot of people, and I think some of the smartest investors that I know have also been in that same position. I've been waiting. I myself personally haven't invested in a deal, even as a limited partner, for the last 18 months. Just looking for the right opportunity to come. And unfortunately, there haven't been many. There are some out there, but still just waiting for it. But what's your perspective on that? You obviously you're looking for something. You said knock on wood, but hopefully things are going to come about soon. Do you see that shift like very close? Obviously, we can't predict the future, but what you've been seeing over the past 5 years, kind of culminating in what we're seeing now with the interest rates and with the syndication bubble and everything that's happened.
Yeah, I think we're closer where sellers are just more realistic on where they need to be with cap rates today and where they need to sell at. I still see, really two sides or two camps. I see some syndicators buying stuff, and I think it's overpriced. I think the other thing I see is some syndicators still continuing to buy 60s and 70s vintage property at way too low of a cap rate, way too low of an exit cap assumption. And I think that's where a lot of syndicators got hurt during the last two years. Unexpected deferred maintenance, unrealistic exit caps. And I still see a lot of people still doing that. So they're just continuing on buying assets for the wrong price. And then I see, I think a lot of others that are buying things and they're buying them at the right price and it's the right asset and it's a smart purchase and I think they'll do well. So I still think we have more time to go because the transaction volume is still down. So that tells me that there's still a lot of assets out there where sellers are just not realistic. And we see that every day. We've made offers no less than 3 to 4 offers a week for the last 2 years. We've underwritten 10, 20 deals a week and made offers on several. And it's just crazy how sellers are just not realistic. So that's the problem. But look, if you have a maturity coming up, if you have investors and they're, pressuring you to sell and return capital, they're not going to have a choice. And all that's happening. And now we're getting to a level where interest rates are getting a little bit more predictable. Cap rates are getting a little bit more predictable. So I'm excited about that. I think there's opportunities. And what's important, at least for us, is learn from what's happened in the last few years. And I touched on that as I think people have unrealistic expectations with older vintage properties. We are not looking at any, we've had them, we've sold them.
Yeah.
You don't like the more difficult 60s, 70s vintage value add. You can do it. I don't have the stomach for it. I think it takes on an inherent risk that I am just not willing to take on anymore with mine and my investors' capital. So we're conservative, and that's just where my comfort is.
Absolutely. Listen, everyone has a different investing kind of strategy. I know some people that they specifically target types of properties like that where they can completely gut everything and revamp it. And it's a totally different business model, right? Obviously, you have to have the patience for doing that and have the investors, wait it out and that kind of thing. But I think what you've done, and correct me if I'm wrong, you're still kind of focused on the student housing aspects or larger deals, or are you?
Student housing and conventional multifamily. Our multifamily happens to be 60, 70% of our portfolio, and then the smaller share is student housing. But we love both asset classes, and they perform well for us. I mean, we've had challenging assets in the portfolio that we work through, but yeah, we still like both asset classes and absolutely will continue to buy, just conservatively, and we don't have to deploy capital, and our private credit fund is doing very well. So in the meantime, we just put money into the private credit fund. Our investors do the same, and we keep going until the right opportunity comes along.
Awesome. And just to clarify, in the private credit fund that you're talking about, you're lending to what types of assets specifically?
Yeah, great question. We have a diversified fund, and we lend money to 3 different buckets. Number 1, fix and flippers. We originate those loans, then we actually sell those loans. Number 2, pref equity, as I mentioned, small checks, 500 to $1 million. So for sponsors that we like, geographies we like, and assets we like, things that we would normally buy ourselves, we're finding a nice little niche where That's a place where not a lot of private equity guys play. So we can originate those. We're easy to work with, obviously. We're not a big institution. We understand the business. So that's been a good place for us. And then the last one is small business credit. We lend to small businesses. We found a nice little niche where we can securitize their accounts receivables, their inventory, their equipment, personal guarantees. We file UCC filings, and that's been a great business for us as well. I started doing that to just business owners that I knew personally 20 years ago, and little by little, it's evolved into a real platform for us.
Awesome. And are you seeing the rise in interest in that? I mean, obviously, with the interest rates being high, in general, I assume you're able to take higher interest rates for this type of product for doing those kind of things?
Yeah, our borrower base is willing to pay a premium for certainty of execution and quick execution. So on the small business lending side, we can originate a loan in a week or less. So we're very quick. We're discerning on which loans we even look at because we have great deal flow. So we look at the ones we like, we dig in, and we can execute quickly. So yes, our borrowers are paying us a great rate. We pay our investors 12%. We keep the difference, distribute on a quarterly basis. So it's been very well received by our investors, to make equity-like returns in a debt structure with much more safety. It's a great place to be right now.
And I think a lot of people don't even know that something like that exists. We hear about investing in real estate, but investing in a credit fund like that where you can still get pretty good, solid returns, I'm assuming, and it's safe. The main difference for me, and I think for a lot of people also, it's not real estate per se, and so you don't have certain tax benefits that come along with it, as you know, but other things as well.
That's right. You can't invest in it through a retirement account, and of course have that tax advantage. But yeah, it's different than real estate. So to me, it's not one or the other. It's balancing risk and reward. So debt is much less risky. Cash flow is very consistent, but you're going to have tax advantages and you're going to have likely a higher return, less liquidity. So you can build a chart, pros and cons, which is why it's not one or the other. It's both. So you have a nice diversified portfolio.
100%. Do you see, and I mentioned this a little bit earlier, but just kind of getting a little more on this perspective, because I think a lot of our listeners have been waiting, kind of waiting it out. When is this, market going to shift? When are we going to see things pick up? Are they going to go back to the way they were maybe in 2017 or 2020? Or is it going to be a different marketplace?
I think it's going to be a different marketplace, and I think it's going to be healthier. I think this environment has probably cleaned out some syndicators that shouldn't have been in the business, like we started off at the beginning of our chat. So I think that's going to be good for the market because they're going to be the ones that are not driving up pricing and overpaying because they just don't know any better. I still think it's going to take some more time with interest rates, with the elections, everything that's going on, geopolitical issues that you and I very well know about. All those things I think need to level themselves off a little bit until we have a clear line of sight and a more stable market. Now, we're always going to have wars, we're always going to have geopolitical, but we do need to get past elections. We do need to see where interest rates are going to level out. And then I think buyers or sellers are going to, figuratively speaking, look at each other in the eye and say, okay, here it is. If we're going to transact, we're going to buy and sell. Here's generally where cap rates are. Here's generally how everybody's now starting to view A class, B class, C class, right? And that's where I think you're going to have a lot of agreement and price discovery. And that's when I think the market will start to move more and you'll have more volume, more transaction volume. So I think we're probably a year away in my guess, but we're already starting to see that. So I think, it's kind of like we're here and we're starting to move here and we're going to get to somewhere where we're going to play at this sort of level of volume.
That's amazing to hear. I hope it comes to fruition pretty soon because I think we're all looking forward to seeing a bit of a change in the marketplace. And change is good, I think, for a lot of people who don't even know what to expect. We're in this for the long haul, right? I mean, you've been in it for the long haul, and I assume you're still in it from here on out for the long haul as well.
100%. I love this business.
So yeah, I mean, so people who kind of are short-sighted and have only been around in the business for, a year or 2 or 5 or even 10 for that matter, there's still a lot to come, a lot to see. So
yeah, you have to be patient. The other thing I've seen is, some of these syndicators are just like a ping pong ball. One day they're doing apartments, the next day they're doing ATMs, the next day they're doing
Yeah.
crypto mining, the next day they're doing car washes, the next day they're doing lending, it's like, you got to figure out who you are, pick a lane.
100%. And stick with it. And yes, I mean, it doesn't mean you can't change up. You can't over time find out what works, but not do everything at once. There's a difference between diversifying and being scatterbrained, right? Being all over the place.
That's right.
Alex, I want to transition to now what we call the final four. And these are 4 questions that I ask all my guests. First one for you is, what is the worst job that you ever had?
With good intentions, I tried to be a server, a waiter at Bennigan's when I was in college. And you know what? Was not a good field for me. I got fired. I think I'm probably the only person who got fired from Bennigan's. So I just did not enjoy being a server. That was probably my worst job.
Yeah, well, as quickly as you go in, you figure out that you leave as quickly as possible as well. Second question, what's a book you've read that's given you a paradigm shift?
So I won't mention a specific book, but I'll mention how I'm reading and what I'm reading, which is through an app called Headway, which is basically summaries, which is great for me that I don't have to read an entire book. I can basically listen to a summary of all the chapters. And I'm listening to a lot of 2 things, either health and wellness, fitness type of books, or I'm listening to a lot of investment books that are not specific to multifamily, but just general investment sort of strategies, philosophies from old school guys who have been around for the last 50, 60 years, investing in private equity, in public equities and real estate. It's been really interesting just to understand how, professional investors think. And that's been really good for me to, kind of recalibrate the way I think about investing.
Okay. Well, we'll make sure to include that. It's always important to kind of expand your perspective on all these things. And there's so much to learn. I mean, constantly, there's so much out there.
But I highly recommend that app.
For sure.
You drive it in a car, they're all like 10 to 15 minutes. So you can listen to a book in 10 to 15 minutes. And then if you want to dig in, you read the whole thing.
Absolutely. I mean, it's awesome. We'll make sure to include that. Third question is going to be, what is a skill or talent that you would like to learn?
So I've recently, in the last couple of years, been dabbling a little bit with pickleball and paddle. So I'd love to. In fact, I'm going to take some lessons and take it more seriously. And I've been an athlete my whole life and love sports, love competition. So love to get more serious about it and stay fit.
That's a great way to do it. Absolutely. Fourth and final question, what does success mean to you?
To me, it is to be able to do what I want and to make an impact on my family and the world. So if I can do that through my business, if I can have financial freedom to to turn around and be able to help people, to give my family freedom, and to be fulfilled in doing all that, that for me is success. It's not about the next house I buy or car I buy or boat I buy. It's really just the ability to have the freedom to do whatever you want. And that's success, and to help people and have an impact along the way. I've success, and I'm on the board of the JCC and have had a lot of fulfillment, helping and working with the JCC. That to me is success, that I have the time and resources now to give back and, to help a greater community.
Good for you. Awesome to hear. And that's really the way to do it. And we always talk about on the show, giving back to the community and doing whatever you can. So happy to hear that and really living your best life. So congratulations to you on all the success and wishing you much continued success on that as well, Alex. So finally, where can our listeners find you or reach out to you if they want?
Sure. Our website is ashlandcapitalfund.com. My direct email is Alix with an I, which always gets missed. Alix, ALIX, at ashlandcapitalfund.com.
Okay. We'll make sure to put that in the show notes. And thank you again. It's really been a pleasure. I appreciate you taking the time out today and hope to speak to you again soon.
Likewise. Thanks, Yonah. Great to see you as always.
Awesome. And to our listeners, thank you all for listening and tuning in once again, all the way to the end. And remember, the best advice comes only when you ask. Real quick, I have one question for you. Did you like this episode? If you did, I want to ask you a huge favor. See, the biggest thing that helps this podcast grow and that will spread this message to the whole world is that if you leave a review, a rating, and subscribe to the podcast. What that does is it basically tells the platforms that this podcast is out on is that you like my stuff and I'm doing something right. So take a few seconds out of your day, hit that subscribe button, leave a rating or review. I would be extremely grateful. Also, I want to hear from you guys. So I want to hear some feedback. If you have any questions for future episodes, please find me on LinkedIn. Send me a DM, a connection request, Yonah Weiss, and I'd love to hear from you.